So think about this for a second. What if the protective stop loss that you meticulously placed to save your trading account is actually the exact fuel that a massive algorithmic fund uses to generate its quarterly profits?
Oh, man. That is, I mean, it's a brutal thought, but it's the ultimate realization for a technical trader.
Right. You map out your trade, you identify your invalidation level, you place your stop loss just outside the structure to be safe, and then suddenly the market violently spikes, triggers your order, and immediately reverses in the direction you originally predicted.
Yeah, and you sit there thinking you just got unlucky. But you didn't. You provided the exact liquidity an institution needed to fill their block order.
Exactly. And that shift in perspective is the entire focus of today's deep dive. I'm your host, and we are going to get right into this because the source materials today are absolutely fascinating.
I'm thrilled to be here to break this down. We've got a really intense stack of materials from the trenches of day trading education.
Yeah, specifically, we're looking at manifestos, video outlines, and strategy guides from Bunnex Investment Group, Stacy Burke Trading, Christina Forex, and T-Trades. Our mission today is to decode what they call the weekly high-low trading strategy.
But, we aren't just going to talk about drawing lines on a chart. We really need to break down the actual market microstructure, the algorithmic realities of liquidity sweeping.
Right, the psychological warfare between retail flow and institutional execution. But I think we also have to address the massive elephant in the room regarding these sources, don't we?
Oh, absolutely. Because we are looking at some highly technical, conceptually sound, mechanical models of order flow here. But they are packaged inside some of the most aggressive hyperbolic marketing the internet has to offer.
Yeah, like how I made $7,000 in 1 week with this one simple trick, that kind of stuff.
Exactly. So we have to separate the actual mechanics of price action from, the illusions of simulated trading environments and hindsight bias.
We're going to tear the hood off those claims and look at the actual matching engine underneath. So let's start with the core structural concept.
Let's do it.
In the materials from Bunnex Investment Group, they outline the high and low of the week strategy. And then Christina Forex echoes this with the previous day, low and high.
Right. So the basic premise here is that you define the absolute extreme price boundaries of a specific time cycle, like a day or a week.
And you only look for entries exactly at those perimeters. But why? Why do these specific boundary levels act as such, formidable zones of support and resistance?
Well, to understand that, we have to step away from the retail concept of trend lines and actually look at the order book.
Right, because trend lines are subjective.
Exactly. But when a market establishes a weekly high, it means that at that specific price coordinate, the aggregate supply overwhelmingly absorbed all aggressive market buy orders.
The buyers just ran out of ammunition?
Yeah. Passive limit sell orders cap the advance. And as the week progresses, that level becomes this huge structural beacon.
Because literally every trader across the globe, regardless of whether they are using a 5-minute chart or a 4-hour chart, can see that exact specific price point.
Right. And because everyone sees it, orders cluster around it, it creates a massive concentration of resting liquidity.
Let's break that down for the listener. If you are shorting the market as it approaches that weekly high, where do you put your stop loss?
You put a buy stop order just above the weekly high.
Right. And if you are a breakout trader waiting for the market to surge to new highs, what do?
You put a buy stop order just above the weekly high to catch the momentum.
So just above that boundary, you have a massive overlapping cluster of buy stop orders. And a buy stop order, once triggered, becomes a market buy order.
Right, which executes at whatever the next available price is. This creates an intensely binary structural environment at the boundary.
Binary meaning it's going to do one of two very extreme things.
Yes. When price approaches the middle of the weekly range, which is usually the volume-weighted average price for the week, it's chopping through balanced liquidity. It's just noise.
But when it tests the extreme edge,
it hits that pocket of concentrated orders. So the market either triggers all those buy stops, tearing through the thin upper liquidity and causing a massive expansion, a true breakout, or the passive limit sellers at that level absorb the buy stops completely, trapping the breakout traders, and the market violently rejects back into the range.
I picture it mechanically like a highly tensioned spring, or maybe like a massive game of tug-of-war.
Oh, I like that.
Yeah, like in the middle of the range, the spring is loose, the rope in the tug-of-war is just sort of swaying, it bounces around, it's muddy, the order flow is two-sided and balanced.
But no clear winner.
But when you push the price to the absolute high of the week, You are compressing that spring to its absolute physical limit. The tension is maximal.
Someone has to let go of the rope.
Exactly. It either snaps the retaining pin and explodes upward, or it violently decompresses and launches price back in the opposite direction.
That tension is pure order flow dynamics. And Christina Forex's material specifically notes that these boundary strategies are designed to, quote, provide clear entry and exit signals.
Because from a risk-to-reward perspective, trading the boundary is optimal. Your invalidation is immediate.
Right. If you take a short position anticipating a rejection at the weekly high, your risk parameter is incredibly tight if the price sustains a break above that level and holds.
The premise is dead. You're wrong. You take a tiny loss, and you exit.
You aren't stuck in the middle of a choppy Tuesday session hoping your moving averages cross. You are trading the exact point of structural failure.
And we see this principle applied universally in the source text. I mean, T-Trades and Christina Forex explicitly reference assets across the board.
Yeah, we see titles like Bitcoin. The window of weakness is open, right alongside Forex analyses like Forex traders are not ready for this DXY move.
They're looking at EURUSD, GBP/USD, gold. That doesn't seem to matter.
The asset is irrelevant because the continuous auction mechanics remain exactly the same.
Right. A matching engine processing Bitcoin orders operates on the exact same liquidity principles as the interbank Forex market processing euro orders.
Human fear, greed, and the programmatic algorithms designed to exploit them, they create the exact same liquidity clusters at weekly boundaries regardless of the ticker symbol.
Okay, let's visualize this on a chart to make it really concrete for the listener. Let's say we are looking at gold, XAUUSD.
Perfect example.
So it opens the week on Monday, drops heavily, and establishes a clear low by Tuesday morning at, say, $2,300 an ounce.
Okay, $2,300 is our weekly low.
Right. Then it spends Wednesday and Thursday slowly grinding higher, chopping around $2,300, $20. Now it's Friday. The market starts selling off aggressively, heading straight back down to that $2,300 weekly low.
And this is where the retail mindset kicks in. A retail trader looks at that momentum on Friday and thinks, it's crashing, I need to short this right now.
Right. And that is exactly where the Stacy Burke trading material introduces the concept of the trap.
Burke's manifest heavily emphasizes ditching that retail trader mentality and understanding smart money manipulation.
Because as gold approaches that $2,300 weekly low on Friday, the institutional algorithms are not looking at the momentum. What are they looking at?
They are looking at the liquidity pool resting just beneath $2,300.
The sell stop orders. Every retail trader who bought gold throughout the week has their protective sell stop resting at $2,298 or $2,295.
Precisely. Now imagine you're a major institution. You need to accumulate a massive long position in gold. Say you need to buy thousands of contracts.
You can't just click buy at market on your broker app.
Right. You cannot simply execute a market buy order at $2,305.
Yeah.
The order book is too thin. If you buy it at market, you will consume all the resting sell limit orders all the way up to $2,320.
You'd experience massive positive slippage. You're essentially driving the price up against yourself and completely ruining your average entry price.
Exactly. So they need a counterparty. To buy a massive amount of gold without moving the price, they need a massive amount of sellers willing to sell to them at a discount.
And where is the largest concentration of guaranteed automated sellers, resting right below that weekly low?
So the smart money entities, or more accurately, their VWAP and liquidity-seeking algorithms, will intentionally and aggressively short the market on Friday morning.
Wait, they sell to buy?
Yes. They spend a little bit of capital to push the price down, just enough to break that $2,300 weekly low.
And boom, this is the stop-loss hunt. The price drops to $2,295. All those retail protective sell stops are triggered.
They instantly become market sell orders, blindly hitting the bid, desperately trying to exit their long positions.
And waiting right there on the bid are the massive limit buy orders of the institutions. They absorb all that retail panic.
The retail traders sell at the absolute bottom, feeding the institutional algorithms the exact liquidity they needed to fill their block orders.
Wow. And once the orders are filled, the selling pressure just vanishes.
Exactly. The institutional buying takes over, and gold violently reverses, rocketing back up into the weekly range.
It's absolutely ruthless, and it perfectly explains the feeling every trader has experienced getting stopped out by 3 pips, only to watch the market immediately go to your target without you.
It's the most frustrating feeling in the world.
But you know, I want to push back on the terminology here just a bit. Because the Stacy Burke materials use this highly predatory language.
Oh, yeah. Stop loss hunting, smart money manipulation, liquidity sweeps.
Right. It paints a picture of a cabal of hedge fund managers sitting in a smoky room laughing as they target a retail trader's $4 account.
Which is a narrative that sells very, very well on YouTube.
Exactly. When you look at titles in our stack, like Riley Coleman's How to Day Trade with Only $4, it highlights the absurdity of the conspiracy. A billion-dollar fund doesn't care about your $4.
No, they don't even know you exist.
So is this really malicious manipulation, or is it just the natural mechanical byproduct of continuous auction markets? Isn't hunting liquidity just what a matching engine inherently does?
I'm glad you brought that up because it is entirely structural. It's algorithmic physics, not a personal vendetta.
Right.
Algorithms are programmed to minimize execution costs. To do that, you must find deep liquidity. And the deepest liquidity is at the structural boundaries.
So the market naturally gravitates toward those areas like water flowing toward a drain.
Exactly. The manipulation is simply the temporary imbalance created to trigger the cascade of orders. It's not evil, it's just math.
Okay, so if you're a retail trader, you are basically trying to pilot a little dinghy in the wake of a massive cargo ship. You want to catch the current the ship creates, but if you sit right behind the propellers at the weekly low...
The cavitation is going to shred you to pieces.
Yeah. That cavitation is the liquidity sweep. The retail mentality is to anchor your boat right on the boundary line and just hope the cargo ship stops perfectly in front of you.
And the professional mentality, which is emphasized heavily in these materials, is to wait for the ship to pass.
Let the propellers churn up all the stop losses.
Right, and then ride the displacement wave once the actual direction is established.
Which brings us to the operational mechanics.
Yeah.
Because understanding that the trap exists is only half the battle, right?
Right.
If you know the market is going to probe below the weekly low to sweep liquidity, how do you know when it's actually a sweep versus a genuine structural breakdown where the price is just going to keep plummeting into the abyss?
How do you survive the cavitation?
Exactly. How do you survive the cavitation?
This is where we transition from basic boundary identification to the advanced market structure frameworks provided by the T-Trades material.
Okay, let's get into T-Trades.
T-Trades introduces the concepts of failure swings versus true swing extremes and heavily emphasizes the fractal higher time frame look-back model.
Okay, stop right there. Let's break down that terminology. Because fractal higher time frame look-back model sounds like quantum physics jargon designed to make a YouTuber sound smart. What does it actually mean on your charting platform?
Fair question. The term fractal in market geometry simply means that the structural patterns of order flow are independent of time.
Meaning a chart is a chart.
Exactly. A liquidity sweep on a 1-minute chart operates on the exact same mechanical principles as a liquidity sweep on a monthly chart. The higher time frame look back is basically the ultimate filter for the noise of the lower time frames.
Right, because the biggest trap a day trader falls into is tunnel vision.
Oh, absolutely. Imagine you are executing on a 5-minute chart. You see the price of your USD smash through the weekly high.
Okay, so on a 5-minute chart, it looks like a massive high-volume breakout candle. The momentum indicators are screaming buy.
The retail FOMO kicks in, right? And you execute a long position.
Because it looks like it's going to the moon.
But if you had simply utilized a higher time frame look back, if you had toggled your chart to the 4-hour or the daily view, you would have seen a completely different structural reality.
Because on the daily chart, that massive 5-minute breakout candle isn't an expansion at all. It's just the very tip of a wick.
Precisely. On the higher time frame, you see that the price briefly poked above the weekly high, triggered the liquidity, and immediately closed back within the previous range.
It's a trap.
It is. What looked like a breakout on the 5-minute chart is instantly recognizable as a failure swing on the daily chart. The higher time frame dictates the true order flow narrative.
And the lower time frame is just the execution matrix.
Right. And this aligns perfectly with the T-Trade's focus on finding, quote, valid separation in market structure. You aren't just blindly selling the moment the price touches the weekly high.
You are waiting for the market to prove its intent.
Yes. And the text outlines a very specific, disciplined sequence of execution to find that valid separation.
Let's walk through the steps for the listener.
Okay. Step 1. Identify the structural liquidity pools. Mark out those weekly and daily highs and lows.
Got it.
Step 2. Wait for the market to test the boundary.
Okay, patience.
Step 3, and this is the hardest part psychologically, wait out the inducement.
Okay, let's define inducement structurally, because this is like the trap within the trap. What is an inducement?
Inducement is a preliminary structural high or low designed to induce early positioning.
Give me an example.
Imagine the weekly high is at 1.1000. On Thursday, the market pushes up to 1.0990, creates a sharp rejection, and drops.
So retail traders see that as resistance.
Right. They short the market and they place their stop loss just above 1.0990. But that's still beneath the true weekly high of 1.1000.
Oh, wow. They took the bait. They think the reversal started early, so they don't want to miss the move.
And by taking the bait, they just built a brand new, highly concentrated liquidity pool at 1.0990.
So then the algorithm drives the price back up.
Aggressively sweeping the 1.0990 stops, pushing all the way through the true weekly high at 1.1000, sweeping those stops, and then instantly collapsing.
Man. So the inducement was the false high that engineered the liquidity needed for the final sweep.
Exactly.
The mechanics of that are just staggering. It requires an immense amount of patience to trade this correctly.
Immense.
You have to map the weekly high. You have to watch the market create the inducement. You have to watch retail traders jump in early. You have to sit on your hands while the algorithm sweeps both the inducement and the weekly high.
And then, according to T-Trades, you look for the market structure shift.
The valid separation.
Right. Once the liquidity is swept at the weekly high, you zoom in to a lower time frame, say the 15-minute chart.
You wait for the price to aggressively break structure to the downside.
You wait for a lower low to print, confirming that the institutional sellers have actually stepped in and the order flow has genuinely reversed.
And only then, on the subsequent retracement back into the newly established supply zone, do you execute your short.
Exactly. Because your invalidation is now resting safely above the true swing extreme, the wick of the sweep itself.
You are no longer the liquidity. You are trading in the wake of the sweep with your risk perfectly defined.
It makes complete logical sense when you map out the mechanics like this.
It does.
Yeah.
But executing that in real time, staring at the flashing red and green pixels on a screen while your P&L is fluctuating, that requires a level of emotional control that borders on sociopathic.
It really does, which explains why the Stacy Burke outline references the work of Mark Douglas.
The pioneer in trading psychology.
Right, and his concepts surrounding the pain of trading. Human neurology is fundamentally misaligned with probabilistic execution.
We are wired to react to immediate threats, like a massive green candle breaking a boundary.
And we are wired to seek immediate rewards, waiting for an inducement, watching a sweep, and waiting for a structural shift completely contradicts our evolutionary hardwiring.
And this evolutionary misalignment brings us to the most fascinating and, frankly, contradictory aspect of our source material.
Let's hear it.
We've broken down the deep mechanics of the order book. We understand the fractal nature of time frames. We understand the necessity of cold, calculated execution. Yeah. But now we have to contrast those harsh realities with the ecosystem that is actually selling this information to the public. We have to look at the marketing reality versus the fine print.
Oh, man. The dichotomy is stark.
Yeah.
Is literally the difference between selling the fantasy of the destination and the brutal reality of the journey.
I want to read some of the exact titles from these source manifests. These are the hooks engineered to capture the algorithm and capture the viewer.
Go for it.
This strategy made me $7,578 in 1 week. Price action trading was hard until I discovered the simple 3-step trick. How I made $1 million in 51 days of day trading.
Wow.
Yeah, and it goes on. The one candle scalping strategy I will use for life. The only strategy I've used for 10 years proven. The only entry model you need.
The language is hyper-optimized for immediate gratification. Simple. One candle. The only model.
It completely bypasses the analytical brain and speaks directly to the dopamine receptors.
And the irony is just overwhelming. Look at that list you just read. We have multiple videos claiming to be the singular, absolute truth of the market.
Right. The only 2 indicators I've used, the only strategy I've used, the only entry model you need. If the mechanics of the market are singular, why are there a dozen different only secrets being sold by the same ecosystem?
Because the marketing isn't selling a mechanical edge. The marketing is selling certainty in an environment governed entirely by probability.
That's a great way to put it.
The weekly high-low strategy, the liquidity sweeps, the market structure shifts, these are high-probability setups, but they are never certainties.
Never. The market can, and frequently does, sweep the weekly high, shift structure on the 15-minute chart, trigger your short entry, and then violently rip upward to sweep you out anyway because a larger macroeconomic order just hit the tape.
And when you scroll past the YouTube thumbnails, past the dopamine-inducing titles, and you actually read the written documentation provided in these same manifests,
you hit the legal reality.
Yes. In the T-Trades document, there is a massive block of text, entirely capitalized, dictating CFTC Rule 4.41.
The Commodity Futures Trading Commission disclaimer. It is the ultimate reality check for retail traders, and it is vital that we break down exactly what it means structurally, because it completely recontextualizes the simple three-step trick.
Let's read it. The first line states, quote, hypothetical or simulated performance results have certain limitations. Unlike an actual performance record, simulated results do not represent actual trading.
This immediately introduces the concept of paper trading versus live execution.
Right. In a simulated environment, you are trading on a delayed or perfectly replicated data feed, but your orders are not actually hitting the exchange's matching engine.
So when the video claims, this strategy made me $7,578, the fine print is loudly whispering that those dollars might have never actually existed.
Exactly. But it's more than just fake money. The mechanical difference between a simulator and a live order book is massive, especially when we're talking about trading breakout boundaries.
The disclaimer explicitly addresses this. It says, also, since the trades have not been executed, the results may have under or overcompensated for the impact, if any, of certain market factors, such as lack of liquidity.
Lack of liquidity. We just spent 20 minutes discussing how weekly boundaries are defined by massive pockets of concentrated liquidity followed by total voids.
So how does a simulator fail to account for this?
Because a simulator assumes perfect fills. Let's go back to our gold example. The weekly high is $2,320.20. You have a buy-stop order at $2,321. Wanting to catch the breakout.
Okay.
In a simulated program, the moment the price feed prints $2,321, the computer registers your trade as perfectly executed at exactly $2,321.
But in the live market, when price hits $2,321, the order book goes chaotic.
Exactly. In the live market, your buy-stop order becomes a market buy order. The matching engine looks for the nearest resting limit sell order to pair you with.
But because it's a breakout, every other retail trader's buy stop just triggered at the exact same millisecond.
And the institutional limit sellers might have pulled their orders, leaving a massive liquidity void above 2,321 balls.
So there are thousands of market buy orders and no limit sell orders to absorb them.
The matching engine has to jump up the order book to find the next available seller. It might not find one until $2,325.
Wow, so your buy stop at $2,321 actually gets executed at $2,325. You just suffered 40 ticks of negative slippage.
Your entry is terrible. Your risk-to-reward ratio is instantly ruined.
And the simulator completely ignores this reality.
Completely. It prints a perfect entry at $2,321, books a massive hypothetical profit when the price hits $2,330, and the educator makes a video about how flawless the strategy is.
But the live trader who attempted the exact same setup got slipped into a terrible entry, panicked during the pullback, and took a massive loss.
The strategy looks mathematically flawless on paper because the paper doesn't suffer from order book slippage.
And the disclaimer hits on one more crucial cognitive trap. Simulated trading programs in general are also subject to the fact that they are designed with the benefit of hindsight.
The hindsight bias is the most dangerous drug in technical analysis.
100%.
When you open a chart on a Saturday morning when the markets are closed, the data is static. The weekly highs and lows are perfectly printed.
The liquidity sweeps look obvious. The market structure shifts are crystal clear.
You can point to the chart and say, obviously, the algorithm induced the retail shorts here, swept the highs here, and I would have entered the perfect short position right here.
It looks like a connect the dots puzzle, but that's because you already know the outcome. You are analyzing the ashes of the fire after the building burned down.
During live execution, on a Tuesday morning, the right side of the chart is completely blank.
Exactly. When the market approaches that weekly high, the candle is violently expanding. It's printing massive green wicks. The momentum indicators are maxed out.
Financial news networks are screaming that the asset is going to the moon.
Your adrenaline is pumping. In that exact moment, deciding to wait for a sweep, wait for a structural shift on a 15-minute time frame, and short into the face of massive bullish momentum.
It feels completely insane.
Hindsight removes the psychological weight of uncertainty. It removes the fear of execution. And that is the massive disconnect between the marketing and the reality.
The educational content effectively teaches the mechanical theory of market structure. And as we've discussed, that theory is incredibly sound. It is based on verifiable order flow dynamics.
But the marketing strips away the probability, the slippage, and the psychological warfare required to actually execute the theory.
It reduces a highly complex, probabilistic matrix into a simple three-step trick.
And that is why so many retail traders enter the market armed with these strategies, only to become the very liquidity they were trying to exploit.
They understand the what of the weekly boundary, but they haven't mastered the how and why of institutional order flow execution.
Which perfectly summarizes the mission of our deep dive today. We set out to decode the mechanics of the weekly high-low.
We didn't just look at drawing lines on a chart.
No, we explored the deep structural realities of the matching engine, how concentrated stop-loss clusters create immense tension at the boundaries of the week, and how binary those breakouts or rejections truly are.
We analyzed the algorithmic reality of liquidity hunting, how institutions must sweep the boundaries to generate the counterparty flow necessary to fill massive block orders without suffering slippage.
We looked at the advanced mechanics needed to survive that cavitation. We broke down the necessity of the fractal higher time frame look back,
Filtering the noise of the 5-minute chart by zooming out to the daily perspective to identify true swing extremes versus failure swings.
and we detailed the immense patience required to wait for an inducement, watch the sweep, and only enter upon a confirmed market structure shift.
And finally, we grounded the entire theory in the harsh reality of CFTC Rule 4.41.
We separated the dopamine-fueled marketing titles from the structural realities of simulated perfection, order book slippage, and the dangerous illusion of hindsight bias.
It's been a lot to cover, but it's so important.
It really is. Which brings us back to you, the listener. Have you ever mapped out the weekly highs and lows on your own charts?
Yeah, we'd love to know.
When the price reached those extremes, did you experience the clean binary breakouts promised by the theory? Or did you find yourself caught in the vicious liquidity sweeps and inducements we discussed today?
Do you factor order book slippage into your risk management? Let us know how these mechanics play out in your own execution.
The market is a continuous, evolving puzzle. The moment you think you have solved the structure, the algorithms adapt.
Absolutely.
And I want to leave you with a final provocative thought that's been brewing in the back of my mind as we've analyzed this massive ecosystem of trading education.
Let's hear it.
The entire premise of all these manifests, from Stacy Burke to T-Trades, is to stop thinking like a retail trader. You are supposed to learn these mechanics, ditch the herd mentality, stop placing your stops exactly where everyone else does, and start trading in the wake of the smart money.
That is the stated goal of the entire industry.
But think about the mathematical scale of this education. Look at the metrics in our source material. We have educators with tens of thousands, hundreds of thousands, sometimes millions of views.
Millions of retail traders are watching these videos.
Right. They're learning to identify inducements, learning to anticipate liquidity sweeps, and learning to wait for market structure shifts on the 15-minute chart.
The knowledge is becoming democratized.
If the educational content eventually succeeds, and every retail trader learns to perfectly execute the smart money model, who is left to be the liquidity?
Oh, wow.
If millions of retail traders stop placing their protective stops just below the weekly low, the algorithmic hedge funds won't find the sellers they need to fill their block orders.
It creates a structural paradox.
Exactly. Can a mechanical strategy based fundamentally on exploiting the uninformed survive if everyone becomes informed?
If the herd stops walking into the trap, does the smart money have to design a completely new matching engine architecture to hunt them?
Do the boundaries of the weekly high and low lose their tension when everyone is waiting for the sweep, if everyone becomes the predator who is left to be the prey?
It's the ultimate question of market microstructure evolution. The liquidity always finds a way, but the shape of the trap will inevitably change.
Definitely something to mull over the next time you stare at the right edge of a live chart and place your order. Thanks for joining us on this deep dive.